The next topic that we're going to be talking about is inventories. Now, inventories is probably one of the largest asset investments that a company will make that turns over on a regular basis. And the reason why I say that is that most companies have to make a sizable investment in inventory just to be competitive with their competition in the marketplace. They have to be the inventory has to be available so that a customer is in a position to buy that inventory item from the company. Now, when we keep track of inventory, there's two ways that we normally keep track of inventory. And the decision on whether to track it in one of these two methods depends upon the type of inventory that you have, as well as the technology or the ability to keep track of that inventory. The two methods of tracking that inventory are the periodic and perpetual inventory methods. The periodic inventory method is just that. We keep track of our inventory on a periodic basis, which we update our inventory quantities at the end of a period, and we do not keep track of our inventory on a real-time basis where we know exactly what we have in inventory at any given time. Now, in the past, this method was probably the most popular method because many companies didn't have computer systems, nor did they have the employee resources that could keep track of inventory and update the inventory as sales occurred or as inventory was received. So, they used to keep track of inventory periodically where they would update that inventory as at the end of every time period. We introduced to you the periodic inventory formula in another topic when we were talking about the sales process within a merchandise company. So once again, just to review real quick, the periodic inventory formula is beginning inventory plus net purchases. When you add those two together, you get goods or merchandise available for sale, at which time if you subtract out your ending inventory, you get your cost of goods sold. Now, this formula is an algebraic formula that, once again, you can interchange cost of goods sold. If you know what cost of goods sold is, you could switch it with the ending inventory to determine how much your ending inventory is. Now, this periodic inventory formula is used in a lot of different calculations in determining where an account changes. Because all we're saying here is take what you started with, add in what were the increases to that account, then subtract what's left over to tell you how much you actually used. Now, this works great if you do not have a lot of inventory, or if you're in a business that doesn't require inventory to be kept track of all the time. But because of computers and because of the competitiveness of today's economy, most companies have computer systems that can track their inventories, and they can track their inventories to the moment so that at the time of a sale, we reduce the inventory, recognize the cost of goods sold, which is an expense, and match that at the time of the recognition of the revenue. Now, the perpetual inventory system is meant to do that. We update our inventories at the time of the transaction, and because of that, we always know exactly what we have in inventory. Now, in today's business environment, because of the linkage of computers, even between locations, that perpetual inventory method provides us with a valuable tool when we're trying to minimize the amount of inventory we keep on stock, but yet be able to provide good service to our customers. Now, besides the physical flow and the actual quantities that are available within our organization, where we keep track of it using periodic perpetual, the other part of keeping track of inventory is what the inventory costs. Now we look at the inventory costing methods. There's basically 4 ways that we keep track of inventory. First is specific identification. Specific identification is where we specifically identify the cost of the specific inventory item that we have in inventory or the inventory item that we have just sold to a customer. Now, the specific identification method is very accurate, but also it takes a lot of work to keep track of if you have a lot of inventory. So most companies that do use the specific identification method for keeping track of costs normally have large items, large dollar items that do not sell a lot of them. So for instance, if you are selling heavy equipment or you're selling some sort of a product that you do not sell a large quantity, you may consider using specific identification. Now, the specific identification also would work is that if you have a very customized item. For instance, a car dealer would want to keep track of their cost of their inventory using specific identification because, yes, they're going to have a large quantity of cars they sell, but each car is different. When they add on special floor mats or special wheels, or they add all the different extras on that car, that makes that car unique. And they need to find out exactly what it costs them when they sell that car so they can determine what their gross profit is. Now, if the item is a repetitive item and it's something that they sell a lot of, they probably don't want to use specific identification. And instead, what they probably want to do is one of the 3 other methods. The first one called first in, first out. And the whole idea of first in, first out is that the first item that you purchase is the first item you sell. So the whole designation of first in, first out, otherwise known as FIFO, FIFO describes the order in which you are going to cost out your inventory at the time of the sale. So when I sell something, I'm going to use the oldest cost first because the oldest cost is the first item in. Now the other one is called LIFO, or last in, first out. Now the concept of LIFO is just the opposite. What we tell the reader of the financial statement when we're using LIFO is that the cost of goods sold more reflects the actual cost of the product because we're using the most recent purchases first to determine what the cost of the item that's being sold. So last in, first out works really well on the income statement if we're trying to represent on the cost of goods sold the actual cost of what the inventory cost. Now there are other advantages and disadvantages of both FIFO and LIFO. Take a look at the lecture that we do that spends more time talking about FIFO and LIFO, but the FIFO and LIFO method are both actively used within business today. The other method, which is kind of a compromise between the two, is called weighted average. Now the whole concept of weighted average is that with weighted average, you have to recalculate the cost of the inventory based as prices go up and down. When you acquire a piece of inventory and the price changes, you have to recompute what the average cost of the inventory is. Once you determine the average cost of the inventory, then we really don't have an issue with what we originally purchased it for because we're going to use the average cost for both the ending inventory valuation as well as the cost of goods sold valuation. Now, all 4 of these methods of specific identification, first in, first out, last in, first out, and weighted average can be used in both the periodic and perpetual inventory methods. So probably the best way that we can demonstrate this is by taking a look at a couple of problems that use all 4 costing methods in the 2 different inventory methods. So let's go to the problems and we'll see how these problems are calculated. Our first inventory exercise that we want to show you is the comparison between the 4 different costing methods using a perpetual inventory system. So we have specific identification, weighted average, FIFO, and LIFO. Under here, we say Laker Corporation reported the following January purchases and sales data for its only product. And what we have here is beginning inventory of 140 units at $6, which gave us a total of $840. We sell 100 units at $15. We purchase 300 units at $5.60, and then we sell additional products and we purchase some more. Now, normally what I suggest most of my students to do is when we set this up, especially for a perpetual inventory method, is that we set it up in such a format so that in that format we can compute exactly what is our cost of goods sold, what our purchases are, and also what our ending balances are. So let's do this. Let's set some columns up. So the first column I want to set up here is my purchases. The second column that we need to set up is our cost of goods sold. And then the last column we're going to set up here is our ending balance, because we need to keep track of exactly what we have in inventory at any given time. Now, I'm going to hold off on specific identification right now. Let's work out the weighted average and the FIFO-LIFO first. So the first thing we want to do is we want to compute what the cost of goods sold is for weighted average. Now, what we normally will do is we'll start with the beginning balance. Now, we're going to start with 140 units times $6, because that's how much was in our beginning balance. So, which basically means that at the beginning balance here, we've got 140 units at $6, which equals $840. Okay, so now the next thing we do is we sell 100 units. So we're going to sell 100 units. And at this point, where we have 140 units at $6, our average cost is $6. Nothing's changed, so it's at $6. So therefore, my cost of goods sold is $600. So what we did is we sold 100 units times our average cost of $6 to give us $600. Notice the $15 here. This $15 isn't our cost. This is the retail price that we're using to sell the product. We're going to need to know that in order to compute what the sales dollar amount is. Okay, the next transaction is a purchase on January 20th. So we have a purchase. And in this purchase, we purchase 300 items times $5.60, which will give us $16.80. Now what we have to do is first figure out here is how many do we have left. We have 40 items left at $6. Get our ending inventory. So it'll give us $240 left. Now what we have here is we have 40 items at $6, which gives us $240. But also we get 300 items times $5.60, which will give us $1,680. Now if I add these two together, we have a difference in price here, $6 and $5.60, so our average cost is going to change. So what we have over here is we have $240. We'll put a little formula here. $240 plus the 1,680 divided by the number of units we have. We have 40 units from what we started with plus another 300. So we have 340 units. So our new cost is going to be, if I got my formula right, over here, I gotta put an equal sign. $5.64.7. So we're gonna round that to $5.65. Okay? So now that we have a purchase, now we have the sale. We sold 250 units times $5.65. So 250 units times $5.65 is going to give me let's see, 250 times $5.65. It's going to give me $1,412.50. Okay, which now provides me, and I'm going to give myself a little bit of room here. Is how many items do I have left? I started with 340. I sold 250. So therefore, I have 90 left at my new. Let's try that again. At my new cost of $5.65. And that is $508.50, which is my ending inventory at this point. Now the last one we have to do is my last purchase. And here I purchased 100 items at $5 or $500. So now what I have here is I have 90 items at $5.65, which gave me $508.50. Plus, I have now 100 items times $5, which will give me 500. So if I take $508.50 plus 500 divided by 190 units, I have to make sure my formula, I use a parentheses here. My new cost is $5.31 as my new average cost. All right? So what I have here is if I add these two together, I've got ending inventory of $1,008.50. And now my cost of goods sold here, if I add the 600 plus the 1,412, I will have my cost of goods sold of $2,012.50. So what we're going to do is we're going to put that right here in cost of goods sold. And I'm going to round it just so it makes it easier, $2,012. All right, so that's how we would figure out the average cost, the weighted average method for cost of goods sold. Now let's do the exact same thing, and I'm going to zero this out so that we can use the same format. Now, let's figure out using FIFO. FIFO, on the other hand, is first in, first out. So if that's the case, my ending balance after my purchase here is I still have 140 items times 6, which is going to give me $840. Now when I sell the items, because this is what all I have in here, I'm a first sale of 100 items times $6, which is going to give me $600 in cost of goods sold. I will have 40 items left times $6, which is going to give me $240. Now next I purchased another 300 items at $560. So what's going to lead this up to is I'm going to have 40 items times $6. I'm also going to have 300 items times $5.60. Now here, our next one is the sale. And in the sale here, I sell 250 items right here. So I'm going to sell 250 items. Well, if I'm doing this first in, first out, I'm going to sell the first item, which is the $40, the 40 items first, because that's my oldest, and then I'll get the remainder from the 300. So what I'm going to have here from the sale, I'm going to sell 40 items times $6, which is going to give me $240. But I need another 260 items, right? How many did I sell? Oops, I didn't sell that many. I sold 250. So I sold 250 items. I sold the first 40, 210 items times $5.60. So I take 210 times $5.60. That's going to give me $1,176. Now my ending inventory is going to be consisted of, I sold all the 40, now I sold 210, so I have 90 items times $5.60. So 90 times $5.60 will give me $504 left over. Now this last purchase, I buy another 100 at $5, so that leaves me with 90 times $5.60, which will give me $504 on that one. But then I buy another 100 times $5, which is going to give me another $500. So I'm going to have an ending inventory of $1,004. And then over here, my cost of goods sold was the 600 plus the 240 plus the 1,176. So if I add up the 600 plus the 240 plus the 1,176, I'm going to get my cost of goods sold for FIFO will be 2016. Okay, so that's my FIFO calculation. Now let's do this again using LIFO. So I'm going to, once again, I'm going to clear out my calculation area here. Now, once again, with my beginning balance, we're using last in, first out. I'm going to take 100, I'll have 140 units times $6, which will give me 840. Now, here with cost of goods sold, I sell 100 units times $6, which is going to give me 600 in cost of goods sold. How much is left? If I sold 100, I have 40 left times $6, which is going to give me $240 left. Now that I purchase 300 items at $560, it'll give me 40 items times $6, which will equal 240. But we also now have 300 items times $560, which will give us 1,680. Now at this point in the time of the sale, we sell 250 items. 250 items, but now we're going to go last in, first out. We do last in, first out. Of these two items, the 40 being the oldest and the 300 being the most recent purchase, or the last in, we're going to sell all 250 out of this group of 300 because it's the most recent purchase. So we're going to take 250 units times $5.60. And it's going to give us 1,400. So what is remaining in inventory? I'm going to have 40 items times $6, which will equal $240. But I'm also going to have 50 items times $5.60, which will give me $280. And finally, the last one here, when I buy another 100 items at $5, I'm going to have 40 items times $6, because I'm keeping track of all my layers. It's going to be $240. I'm going to have 50 items times $5.60, which is going to give me $280. And then also I'm going to have 100 items times $5, which will give me $500. So then my ending inventory here will be the 240 plus the 280, or 520, and the 520 plus the 500. So I'm going to have 1,020. And in my cost of goods sold, I'm going to have the 600 plus the 1,400. So my LIFO cost of goods sold is going to be $2,000. Adding these two numbers together. Okay, the last thing we have to do is figure out the cost of goods sold using specific identification. And using specific identification, according to the problem it says here, Laker used a perpetual inventory system. Ending inventory consists of 190 units. And for specific identification, they are 100 from the January 30th purchase, 70 from the January 20th purchase, and 20 from the beginning inventory. So if we were to figure out what my ending inventory is, so from the beginning inventory, according to the problem, it says 20 items left. From the January 20th, we have 70 left. And from the January 30th, we have 100 left. Okay? And if we have the costs, so if we have our costs here, so of the beginning inventory, our cost was $6. From the January 20th, it was $5.60. And from the January 30th, it was $5. We can extend that out. Take the 20 times the 6. And we can do the same thing for the others. So what we have here is our ending inventory is 1,012. Now that's not our cost of goods sold, that's our ending inventory. So, remember our beginning inventory formula? We need to know what's available. So if I said, what's my beginning inventory plus purchases, I could say my beginning inventory, which was $840. Well, actually, it was $840, plus my purchases, And if I added up my 1,680 and my 500, which will give me $2,180, my goods available is going to be the sum of the two, or 3,020. Subtract minus my ending inventory, of 1,012. So what I'm going to have is my cost of goods sold of 2008. So this is my 2008. Okay? So now what this problem wanted us to do is do a comparison. So if I did this and I sold 350 items and both of the sales are at $15, I could do a little formula here that says 350 times $15. I sold $5,250. Now I could have done the exact same thing for all of them because the sales price hasn't changed for these. So it's all $5,250 in sales, regardless of what the costing method was. So the gross profit's going to be different because my cost of goods sold are different. So what I want to do is most of the formula for gross profit, take my sales minus my cost of goods sold, and that gives me gross profit. I can do the same thing for the other three methods, and I come up with the gross profit for weighted average, FIFO, and LIFO. The next thing we need to do is the expenses, and according to here, it says assume the expenses are 1,250. So we're going to take 1,250, and it's the same amount for all of them, so we'll move those over. So the income before taxes is going to be the gross profit minus the expenses. Same thing for all of them. Now the income tax expense, the calculation is how much is your income before taxes times the tax rate. And the tax rate is 30%. So we're going to take the income before taxes times 30%. Then we can copy that to all the other methods so that our net income will be the difference between our income before taxes minus our income tax. And it's the same for all four methods. So that's how you calculate the difference between the four methods: specific identification, weighted average, FIFO, and LIFO. So now let's go take a look at another problem. Alright, our next problem has to do with, once again, doing a comparison between FIFO, LIFO, and weighted average, but this time we're going to use the periodic inventory method. Now in this particular problem, what they tell us here is that QP Corp sells 6,500 units of its product at $50 per unit in the year 2008 and incurs operating expenses of $5 per unit in its selling the units. It began the year with 700 units in inventory, these items right here, and made successive purchases through the year at these prices. So altogether we have 7,100 units. What they want us to do is they want us to calculate the differences in net income between FIFO, LIFO, and weighted average. Now, first of all, when we set this problem up, the same sales is going to be the same regardless of whether we're using FIFO, LIFO, or weighted average. So if I take 6,500 units times $50 per unit, I'm going to get $325,000 in sales regardless of which method I'd use. Next, we're going to do the cost of goods sold. Now remember, the cost of goods sold calculation is based upon the periodic inventory formula of beginning inventory plus purchases, which gives you goods available, minus your ending inventory, which will then give you your cost of goods sold. So what they tell us that our beginning inventory was 700 units at $18 per unit. So our beginning inventory, we do that math out, is $12,600. Now the $12,600 is going to be the same between FIFO, LIFO, and weighted average because that's what we started with based upon the prior calculation of the previous period. Now the purchases, we purchased 1,600 units at 19, 800 units at 20, 500 units at 21, and 3,500 units at 22. If we were to extend these out and add them all up, our purchases would come out to $133,900. Now once again, nothing's going to be different between FIFO, LIFO, and weighted average. So now I have my beginning inventory plus purchases. If I add the two together, I'm going to have my goods available for sale. Since the values for FIFO, LIFO, and weighted average are the same, I can copy my formula and find out the goods available for sale, regardless of whether we're using FIFO, LIFO, or weighted average, is going to be the same. So where the difference occurs is here after goods available. In the first one, in ending inventory. Ending inventory here, they tell us that there are 700 units left over in inventory at, it began the unit with 700 units, and they sold 650 units. So altogether, if there were 7,100 units available, let's do the available, and we have 7,100, and we sold 6,500, we can subtract the two, and it shows that our ending quantity is 600. So, if that's the case, when we do FIFO, first in, first out, we're going to sell the first items first, and what's going to be left over is the more recent purchases for first in, first out. Remember, we're going to sell the oldest item first. So basically our ending inventory is going to be 600 items using a cost of $22 per unit. So we're going to say 600, do a formula and say 600 times $22 per unit. And that's going to give me an ending inventory of $13,200. Now, at this point, I can now figure out my cost of goods sold by creating a formula and say, take my goods available, subtract out my ending inventory to give me my cost of goods sold. Okay? Now, let's do that for LIFO. Now, LIFO is going to be different. We still have 600 items left over, but now when we sell items, we're going to take the most recent purchases first. So in other words, what's left over is going to be the oldest items. So I'm going to have 600 items being costed out at the $18 per unit. So I can create a formula again that says take my 600 units times $18, and I'm going to get an ending inventory value for my LIFO method of 10,800. Once again, if I take that same formula to figure out cost of goods sold, which is subtract my goods available from my ending inventory, I'm going to get cost of goods sold of $135,700. Now the last one's a little bit trickier. At this point, goods available was 146,500, and I had 7,100 units. So if I needed to figure out what my weighted average cost was, I would have to take the 146,500 and divide it by the number of units available of 7,100 units, which I'm going to get my average cost of $20.63. So if that's the case, once again, my ending inventory amount, I've got 600 items left over in ending inventory times my cost of $20.63. So I'm going to get $12,378 as my ending inventory. Take the same formula for giving my cost of goods sold, and I now have $134,122. Now, the problem that you might run into when you're working this problem in Homework Manager is that we rounded our average cost here. And if we round up our average cost here, we may be different than Homework Manager by a couple dollars because of rounding. So keep an eye on it, and if the system says that you've incorrectly answered it, check to see if you rounded it differently than the computer did. Anyways, but now let's figure out what my gross profit is. So gross profit is the difference between my sales and my cost of goods sold. So if I take my $325,000 minus my cost of goods sold, I'm going to have $191,700 in gross profit for FIFO. I'm going to have $189,500 for LIFO. And I'm going to have $190,878 of gross profit using the weighted average method. Now, according to this problem, they said our expenses were going to be $5 per unit sold. So my expenses will be calculated out, and they'll be the same for all of them because we sold the same number of units of 32,500. If I subtract out my expenses from my gross profit, I'm going to have income before taxes, which then I can subtract my gross profit from my expenses. And I can copy that also to my LIFO column and my weighted average column. Calculate my income tax, which is basically to take my income before taxes times, and in this particular case, the problem said 30%. So I'm going to have $47,760 in income tax. And then I'm going to do the same thing for LIFO, do the same thing for weighted average. So therefore, my net income is going to be my income before taxes minus my income tax. So under FIFO, I'll have $111,440 in net income. If I do the same thing with LIFO, I'll have $109,760 in net income. And finally, in my weighted average, I'll have $110,865. That's how we compute it and how they're different. FIFO, LIFO, weighted average. Note what happened here with the periodic inventory method. We have to use this calculation, beginning inventory plus purchases, which gives us goods available, minus ending inventory, to give us cost of goods sold. Got it? So there's a difference between perpetual and periodic. Periodic, it's all driven by formula. In perpetual, we have to look at it, we have to work each one of the transactions out to determine what's the effect on our cost of goods sold. Well, good. Now let's go to the next problem. Our next problem is a calculation of lower of cost or market. The reason why we have to adjust the value of our inventory values to lower cost of market is to be more conservative in terms of the valuation of what our inventory costs. Of course, what we've learned in prior chapters is that inventory needs to be originally purchased or originally recorded at the purchase price because that's what it cost us in order to acquire that inventory item. However, there are situations where the replacement cost of the product is permanently affected, and when it's permanently affected, what ends up happening is that the market price is lower and will not come back up. When that happens, where the market price will not come back up, or replacement cost will not come back up, we have to be conservative and we have to reduce the value of our inventory. So what I've done is I've taken this problem where Sunflower Company's ending inventory consists of 24, 17, 38, and 42 units. They provide us with the cost. They provide us what the market value or replacement cost is. And so what we can do is then now we can look at doing the extension to determine what value should we use to be placed upon each inventory item as we determine lower cost of market. So what we can do is we can do a formula that says take the number of units times the cost of that inventory item to give us what the cost is for helmets. Now we can do this exact same thing for the bats, where we take the 17 times the 78. That'll give us 1,326. We can do the 38 times the 95, which will give us 3,610. And then we can take the 42 times the 36, which will give us 1,512. Now we can determine what the market price is. If I take the market price, take the number of units times the market price per unit, which will give us 1,296. We can do the exact same calculation for bats. We can do the same thing for shoes and the same thing for uniforms. Now the calculation for lower cost of market, as it says in this format here, lower cost of market can be applied against three different things: the individual product, the category, or the entire inventory as a whole. Now what happens here is let's figure out what our total inventory is at cost and what our total inventory is at market. So I could do a little formula here to add up my $1,200 plus my $1,326 plus my $3,610 plus my $1,512 to give me my total inventory at cost is $7,648. I can do the exact same thing over here to the market, and the market value is $7,490. Now, so the question then is we have to look at each one of these first by product to determine which is lower, cost or market. In the case of the helmets, the cost is lower, so we're going to take $1,200 here. In the case of bats, the market price is lower, so we're going to take the $1,224. In other words, we have to reduce the value of that inventory item to reflect the decrease in the market price. The next one here is the shoes. Our cost was $3,610, and in our market was $3,458. Take the lower of the two, $3,458. The last one is the uniforms. They're exactly the same price. They didn't change, so we're going to take $1,512. So, if I had to take a look, now that I've taken the lower cost of market by product, I can add up the 1,200, the 1,224, the 3,458, and the 1,512 to get what should my value be look at this. So my value, if I was to go lower cost to market based upon product, the value of my inventory should be $7,394 because I took the lower of cost or market. Or if I take it as an inventory as a whole, looking at here between total cost and total market, I should take $7,490. Now what happens here, when you have a difference between lower cost and market, you need to do an adjusting journal entry. And that adjusting journal entry is going to reduce the merchandise inventory account, and you're going to recognize cost of goods sold. So in the case of here, where we have a difference between the product cost and the inventory and the product cost and the lower cost of market valuation, what I'm going to have is I'm going to have a value. If I take 7,648 minus the 7,394, I need to make an adjustment of $254. So what's my adjustment? I'm going to increase my expense because we're going to reduce the value of the inventory. So debit cost of goods sold, credit merchandise inventory. Just like that. That would be my journal entry to do the lower cost of market based upon product. I could do the same journal entry, just different numbers, by subtracting the 7648 and the 7490 to do the decrease in merchandise inventory by inventory as a whole. All right, so that's this problem. Our last problem that we're going to do here in this chapter is to do what we call the retail inventory method. Now, what happens in the retail inventory method is that there are situations where we don't necessarily have the ability to calculate our inventory. And sometimes we have to estimate what that inventory value is. That could be because of fire or theft or whatever reason where we can't determine what that inventory value is. So that we can do is, if we know the periodic inventory formula, we can actually use that formula to estimate if we know that there's a relationship between cost and retail. So what we can do is we can create this problem here for Alaska Company, where we know what cost is and what we know what retail is. And we can do the periodic inventory formula. So what we say here is our beginning inventory at cost is $469,010. At retail is $928,950. What do we call that? That's what we're selling that in. That's what we would sell that inventory for. If we were to go through our store and count up all our inventory based upon our sales price, that would be our beginning inventory at retail. Now we're going to put in our cost of goods purchases, our purchases. And according to this, it's $3,376,050 at cost. And at retail, it's $6,381,050. Now, if we remember our periodic inventory formula, if we take our beginning inventory plus our purchases, it gives us our goods available for sale. So I can take my beginning inventory plus my purchases to give me, I have $3,845,060 at cost. And then if I have the same formula for retail, I'm going to have $7,310,000 for goods available at retail. Now, if I look at these two numbers, I can take a look at this and say, what's the relationship between cost and retail? At this point, I could create a little formula that says, take my cost divided by my retail, and I get 52.6%. So now, if I sell And according to this problem, I sold 5,595,800, but I had less my returns of 42,800, which then gives me my net sales, which is going to be sales minus my sales returns. My net sales will be $5,553,000, which is basically what I've sold. So in other words, what I have left is my ending inventory at retail, which is basically my goods available minus what I sold, or $1,757,000 at retail. If I want to determine what I have at cost, I can take my ending inventory at cost, and I can create a formula that says, what's my relationship between cost and retail here, the 52.6%, is going to be the same relationship between the cost and retail here. So if that's the case, I can take my $1,757,000 in ending inventory at retail, multiply it times the 52% that I calculated over here, and I come up that my ending inventory at cost is $924,182. That's how you'd estimate your inventory, by remembering the relationships between cost and retail. In some of the other problems in this chapter, you could also do what's the relationship between sales price and cost of goods sold to get gross profit, which is called the gross profit method. In either case, all you have to do is just remember the relationships between your various formulas to determine gross profit, or the relationship between cost and retail. So that's this problem. Good luck for the rest of the chapter. I think we've covered pretty much everything that you need to know. And if you have any questions, feel free to ask.